Welcome to Taking Stock, the show where we take stock of the week gone by and prepare you for the coming week. I am Reema Tendulkar and with me is Prashant Nair. Prashant, what a day it's been for the markets. In fact, the last 2 days have been fantastic.
Oh, absolutely, Reema. And I think what a week it has been, right? Almost completely opposite. You can split the week by Wednesday, Monday, Tuesday. Wednesday was the decider, and then Thursday, Friday, we've completely sort of taken off. Before we move any further, and we will get into specifics of the market, what happened today, what happened over the week, and of course, we'll get into a market discussion as well. Let's take our viewers through the top headlines at this hour. The bulls are in firm control. The Sensex and the Nifty hit all-time highs and scaled 31,000 and 9,600 respectively. Mid-caps outperform on Friday to rally 1.3% and thus regain last week's lost ground. For the week, however, the Nifty ends 1.8% higher, while the mid-caps were down 1.9%.
In big earnings, ITC reports a stable set of numbers for Q4. The stock rallies to hit record levels, while Jaguar Land Rover drives Tata Motors into the fast lane. JLR beats expectations with a healthy margin growth. The stock ends the week 8.5% higher.
Pharmaceutical companies in poor health end the week between 10 and 15% lower due to poor results. Cipla reports a loss in the fourth quarter, while Lupin tanked as the guidance disappoints. Okay, so that's essentially the top stories this week. We were talking about the markets, Reema, so let's just come back to how are we set up? I think the simple question which many people will have is this: where are we headed from here? It's very clear, you can't miss it, that we are at an all-time high, all-time closing high. The Sensex, the Nifty Bank, or the big indices all have closed at all-time highs. To answer that question, and because the question is of a very immediate nature, what happens from here, I think you have to kind of fall back on technical analysis, maybe lean on technical analysis in a little bit. So if you look at today's chart, what essentially has happened is that we have got what is called as an outside day. We are ending the week, and if you look at the weekly chart, we've got what is called the outside week. So it's a bullish pattern. We're not putting up the graph, but it's a bullish technical pattern. On Wednesday, the Nifty essentially had broken below what had been an upward sloping channel all the way back from February of 2017, this year. It was a steep upward sloping channel. On Wednesday, the day when the markets cracked, we kind of breached that channel. But Thursday and today, we basically come back very strongly. We are back in that channel. It's upward sloping. And now, to answer the question about where from here, you basically can just look at the upper end of that upward sloping channel. That is at about 9,960. That's about 4% from here. So, I mean, I think that in a way broadly answers the question about where we might be headed from here. There is visibility of another maybe 4-5% in the immediate run.
Okay, so it looks like 10,000 is not very far away. And markets in a way also saluting 3 years of Modi in government. But walk us through the factors at play, because crude slumped quite a bit in Friday's trade. I
think the numbers are pretty enormous. I think we're a big importer. $1 change in oil prices, from going by memory, is worth about $900 million for India. I mean, as the import bill. I mean, that's the impact it makes. And of course, it has relevance for companies, etc. as well. Big global banks are cutting their oil forecasts by as much as 10%. I mean, the JP Morgan global team has done that. They see oil averaging $45 through financial year 18. Domestic liquidity, I don't think it needs any more kind of support. That argument has been well and truly held up. The global noise is pretty high, especially on the geopolitical front. China, Middle East, US, but well, markets are very successfully, global markets have very successfully sidestepped all of that. There is also a reluctance on the part of analysts, even when they find valuations to be steep, to not downgrade their rating or outlook, etc. And I think that's very natural because momentum is so strong. Why go against the trend? And I think that makes sense. Q4 earnings continue to be pretty mixed. So far, what we've seen is that pharmaceutical companies and banks have taken it on the chin. Otherwise, in bits and pieces, we've seen surprises on the way up as well. But on the back of Q4 earnings, we've already seen earnings being brought down for financial year 18. So, you know, I think that is a worry point for the market.
In fact, let's take all these points forward with our expert joining in, Manishi Raychaudhuri of BNP Paribas. Hi, Manishi. Thank you so much for joining us on the show today. Markets at new record highs. Is there any reason to be skeptical now?
Well, going short or reducing position in this kind of a market can very often be, like standing in front of a running freight train, proverbially. But I would still stick my neck out and say that the market does look a tad overvalued with the kind of outperformance that it has had. We had been arguing, in the same vein for quite some time now. And about 10 days ago, we actually cut down the India position in our model portfolios significantly. We are still overweight on India, but that's hardly about a 10 to 15% overweight compared to the benchmark, while earlier that overweight stance was as much as 40%. So to that extent, we have turned a little bit more cautious on India, and we think justifiably so, because in rest of Asia, the rally in equities has been driven by earnings estimate upgrade. And this is particularly true of North Asia, like Korea and Taiwan, which have had very significant upgrades recently. In contrast, in case of India, while the markets have moved up spectacularly, earnings estimates have only drifted down. Over the last 6 to 8 months, we have seen almost 5 to 6% downgrades to consensus earnings estimates for 2017 and 2018. So this is, in a nutshell, the main concern that we have on India. No, if it had been just a case of premium valuations, we would not have been concerned, because if earnings estimates move up, then what is expensive today might appear cheap tomorrow. But unfortunately, that's not the case in India.
Fair enough. Manishi, you're saying you've cut your overweight on India. But what about funds, emerging market funds as a whole? Do you think they've also reduced their overweight on India?
If I look at Asia ex-Japan and emerging market funds, on an average, these funds are still overweight India. Yeah, so for Asia ex-Japan funds, they are, I think, close to about 2 to 2.5% overweight. For emerging market funds, it would be similar, possibly closer to 3% overweight compared to the benchmark. And I think over last 1 year or so, the extent of overweight position on India has reduced slightly, but not very significantly. And from the discussions that we have with our key clients, the investors, we think that they're likely to continue with this overweight stance for the time being.
Okay. Manishi, let's get chatting about individual sectors. I was looking through your latest report, and you have moved your focus away from some sectors. For example, you have downgraded IT, consumer. Could you talk about those important ones?
Absolutely. So, within India, this weight reduction that I talked about was affected essentially by halving the weight on IT that we had. While we are still focused on the frontline large cap companies in the sector, we have cut down the weight on them, by almost 50% of what we had earlier, because we think that the headwinds that this sector is facing is structural in nature. So the visa issues from the United States may be a near-term headwind. It's possibly a near-term roadblock, which some of the companies would obviously use innovative ways to navigate around them. But the bigger problem that this sector is facing is structural, the threat from artificial intelligence and cloud computing, which would obviously take a much tougher degree of re-engineering of their businesses to navigate around. So that is the medium-term concern that we have. Within the consumer space, particularly the consumer staple space, we are still focused on rural consumption recovery. But within that space, we have moved away from some of the more expensive stocks into the relatively cheaper ones.
So that is IT and consumer where you have reduced your bullishness. But one space which everybody seems to be very excited about is the banking space. And the reason, of course, is the possibility out there about where the fight against NPLs will lead us and how fast that fight can be. What is your view on the subject, Manishi?
I think this is a very important step, that the government has considered and effected. this is, this was actually one of our key takeaways when we visited India in late March, and we met up with quite a few of the policymakers, industry experts, and companies. We realized that there's an increased degree of focus on the part of the government and Reserve Bank of India to tackle the NPA problem. And we have seen a translation of such consciousness into action subsequently. Now, having said this, I must point out that actual tackling of the NPA problem will be a long, drawn-out process, because ultimately the banks, I think, will have to take a call on how much of a haircut they are willing to take on the assets that they want to sell off from their books, and that's never an easy decision. But incrementally, this is clearly a more positive outcome for the sector. For the time being, in our Asian model portfolio, if I look at the Indian banks universe, we are still focused on the retail-focused banks, so the banks which have a much larger proportion of retail lending than corporate lending. And I think, at least in the medium term, these are the banks, despite the fact that they're more expensive, these are the banks that are likely to do better as a consequence of much lower degree of bad asset concerns on their balance sheets.
Okay. So at this moment, what's happening on the NPA front does not allow you to form a very constructive investment view on these companies?
Well, there are a few companies, which would obviously be in a better position to tackle the problem. And in that context, the ones we're looking at are either the very large public sector banks, which by virtue of their large balance sheets would possibly be able to weather the storm in case, there are certain specific assets turning bad. Also, I think the banks which have a very strong deposit franchise, they would also be better placed compared to their peers. But I would think that, as far as actual, the NPA problem translating into credit costs on the P&L account is concerned, we will have to watch for at least another 2 to 3 quarters.
Manishi, thanks very much. So still like the retail banks and not the corporate-focused, corporate-facing banks at this point in time. That's Manishi Raychaudhuri at BNP with a holistic view on the markets. We'll take a very quick break on this note, but when we come back, Ashwini Gujral will be with us for technicals. What is his view now? Now the market has made a new high. He'll also take questions from our viewers. Back in 2.